Hey, dividend seekers. Tired of only hearing about the latest AI hype or sky-high blue chips dominating every finance headline? Well, what if I told you a handful of real bargains are just sitting there on Wall Street, quietly paying fat dividends and waiting for investors like you to wake up? In today's dividend surge ride, we're hunting down 3 undervalued US stocks hidden gems that can potentially supercharge your portfolio, deliver robust passive income, and maybe even reward your patience with a major price surge. Stick with me to the end, and don't forget to comment, which bargain stock do you think has the most upside this year? What does undervalued really mean? Let's get on the same page. What is an undervalued stock? Anyway, it's a company with proven fundamentals, strong cash flow, healthy profits, a solid business model that's trading for cheap often because the market is obsessed with different trends or anxieties are driving prices way lower than reality. Why hunt for undervalued stocks? More upside when the market finally catches up. Steady dividends while you wait for that value to unlock. Helps protect your portfolio during risky times. This approach is classic Warren Buffett. If you like the idea of buying $1 bills for 70 cents, then this video is your next playbook. Meet the value all-stars. Today's lineup includes Pfizer, the post-pandemic giant you likely forgot about. Citigroup, the turnaround bank still waiting for its comeback. Simon Property Group, the REIT king of malls, packing huge yields. 3 very different companies, 3 sectors, and all currently trading at discounts that investors shouldn't ignore. Let's break each one down. Pfizer, pharma's comeback kid? Let's start with big healthcare, Pfizer. Remember the COVID-19 vaccine boom? Everyone sure did, at least until the stock lost over 30% from its all-time high in 2022. Here's the current landscape. Wall Street has moved on, and the price-to-earnings P ratio has fallen to bargain basement levels. That means you're buying one of the world's largest, most innovative pharmaceutical companies for less than the S&P 500's average multiple. Why is it trading so low? The COVID hangover. Investors expect sales to dry up now that vaccines and treatment demand have dropped. Everyone seems to have forgotten about Pfizer's deep pipeline of new drugs, its ongoing acquisitions, and the fact it's been paying and growing dividends through ups and downs for decades. Pfizer's big value drivers. Here are some reasons Pfizer can still be the heart of any dividend portfolio. Rich pipeline, cancer therapies, rare disease treatments, and next-gen medicines are coming fast. Smart M&A moves, strategic buyouts to grow revenue post-COVID. Financial muscle, billions in free cash flow support dividends and growth. Fat yield, today's dividend sits above 5.5%, often beating inflation. Imagine buying Pfizer when everyone's ignoring it, and then riding the wave as it launches the next game-changing drug. This could be one of those portfolio anchor stocks that keep paying you through good cycles and bad. Here's your surge spark analogy. Think of your portfolio like a hospital's ER. With Pfizer holding a key role, you're guaranteeing a steady heartbeat of income to keep the whole system running smoothly even when there's chaos in the market. Quick poll, have you ever owned Pfizer? Did you buy during the COVID panic, or is this your first look? Tell your story in the comments. Next up, let's head to the world of high finance, Citigroup. While heavyweights like JP Morgan and Bank of America have soared, Citigroup's still stuck in the mud. Investors doubt its turnaround, but the market might be writing off this global bank way too soon. Snapshot today. Trading at under 0.8x book value, unheard of for a major US bank, especially one built to weather financial storms. Pays a healthy dividend, usually over 4%, and it's been staying consistent, even with the company's internal transformation. What makes Citigroup so cheap and so interesting? Let's be blunt, turnarounds are messy. Investors have doubted Citigroup for years thanks to restructuring headaches, regulation, and global uncertainty. But what's working in Citi's favor? Strategic overhaul. New leadership is slashing costs, selling weaker units, and refocusing on core strengths. Global exposure, operations in more than 100 countries, giving it a unique foothold in emerging markets. potential for multiple expansion. Even small improvements in profitability or sentiment could re-rate the stock sharply higher. Visual cue: compare Citigroup's price-to-book ratio and dividend yield to JP Morgan and Bank of America. Citi is by far the cheaper and potentially the most leveraged to a turnaround. Ready for the surge spark? Citigroup is the classic muscle car sitting in your grandfather's garage. It needs work, but with the right tune-up, it could leave the newer, shinier models eating dust. If patience is your game, this stock is your project. Question for you: are you a fan of turnarounds, or do you stick to the safe, expensive names? Let's debate down in the comments. Are malls dead? Not if you look at Simon Property Group. This REIT owns the top-tier shopping centers across America, and while news headlines keep yelling about the death of retail, SPG is quietly collecting rent, filling stores, and paying massive dividends. In the last 5 years, even through COVID, SPG kept occupancy rates high and tenants loyal. The stock sold off hard at the peak of pandemic panic, but cash flows bounced back quickly. So what's the real play with Simon Property? Luxury and experience. These aren't the dying strip malls of the 90s. Simon owns premium properties. Think luxury brands, restaurants, entertainment, and mixed-use spaces. Consistent FFO, funds from operations, strong cash generation keeps those dividend checks coming, currently at yields north of 6%. Recovery upside. As consumers rediscover shopping, dining, and experiences in person, Simon stands to win even more. Here's the surge spark. While everyone is chasing tech unicorns or crypto, you're buying into a REIT superstar that's as reliable as LeBron James in the playoffs, resilient, powerful, and a steady points machine. For dividend investors, that's the dream. Ever invested in REITs? How do you feel about real estate versus stocks? Drop your thoughts. Before we get too hyped, let's do a reality check on each name. Pfizer. Regulatory setbacks, drug competition, or expiring patents can kill momentum. Citigroup. Turnarounds can fail to deliver. One big global crisis, and banks hurt first. SPG. High debt and rising interest rates make any REIT more sensitive to recessions or market shocks. Remember, the key with value is patience and diversification. Buy what you understand and spread your risk. Are these picks right for you? Are you chasing high yield and value, or all in on growth? Do you have the patience to hold through nasty headlines? Will you sleep better knowing you have companies in healthcare, finance, and real estate? Building a portfolio across these sectors means steady income and a more all-weather investment plan. That's how long-term wealth is grown and how dividend surge keeps riding the big waves. Let's recap. Pfizer. Resilient healthcare giant with real potential for a second act. Citigroup. Classic value play waiting for sentiment to swing. SPG. Real estate rockstar, feeding investors juicy passive income. Which one do you think will surge the hardest? Type your top pick, your boldest question, or even your own favorite undervalued stock down in the comments. Let's get that surge community growing. Don't forget to hit like, subscribe, and turn on notifications for more videos about high-yield US stocks and the best opportunities for smart, value-seeking investors. Next time, we'll dive into a small cap bursting with potential. Stay tuned and keep riding those dividend waves.